Good afternoon. Time to check in on those markets. And as we started the day, we had mainland Chinese stocks as well as Hong Kong leading the losses in Asia. As it stands right now, world stocks rather easing as markets continue to digest the risks around U.S. House Speaker Nancy Pelosi's visit to Taiwan, as well as the commentary that we got out of two Fed officials yesterday talking up the chances of more aggressive and higher interest rates. On the other side, when we look at oil prices right now, dipping ahead of the OPEC Plus meeting, where we are expecting producers to maintain production with very little room for spare capacity, in a backdrop where the idea around global growth seems to be limited, with people quite fearful that the global growth slowdown will impact fuel prices. Rand was a little bit higher, maintaining some form of ground, 1668 a bit earlier on, but it's come back to around 1675. But we'll get into those dynamics right now and how they are affecting markets with Carmen Belona from Absa Asset Management. Carmen, thank you so much for your time. I mean, how are you digesting the market sentiment around Nancy Pelosi's visit to Taiwan, and how is our JSE holding up against all of this information coming through?
Yeah, yesterday we definitely did see some broad-based weakness across the globe. JSE as well obviously had a negative day, but we're seeing that unwind today. JSE has opened up, or is open at 75 pips up today, but still haven't been able to take away the negativity of Monday and Tuesday. I think in terms of the rhetoric around her visit, it seems to be more about the noise around it as opposed to actual action. But I think people are remaining cautious in terms of what the Chinese government's reaction is going to be.
So when you layer on the geopolitical tensions around Taiwan, and then you add in some of the commentary coming out of the Fed officials yesterday and the economy, is that pointing to more volatility ahead?
It's really hard to say. We're coming out of a time where we've had a black swan event. Even the federal governor has said, and the regional governors as well have said, that even in terms of looking at economics and sort of the technical formulas, we've never seen anything like this. And one thing I can say with certainty was that volatility was probably one of the key themes over the last 12 to 18 months. The volatility index at the moment remains quite inflated at 23 points. We normally look for a level of below 15. We reached a high of, I think, about 57 during the peak of the pandemic. So just to give an indication, I think this is going to remain for a while, specifically on the back of uncertainty around Ukraine and the tensions there, and definitely in terms of geopolitical risks, as you've mentioned.
What's the biggest risk for markets right now? Is it that the Fed does too much too quickly, or doesn't move aggressively enough to deal with inflation?
I think more than anything, it's around the credibility of the Fed. If the market does lose sort of belief in the Fed, that is a key risk. They've already come out, or the rhetoric already is that they reacted too slowly. We did see inflation rise significantly into the end of last year in the US, but most people had thought it was going to be transitory. It proved to be the opposite, and we're sort of seeing levels of 9.1% in June. And so the question now is, the front loading that they have done once they started the increase in the interest rate in March, whether that is going to yield anything. So I think next week's CPI numbers are going to give an indication as to the path going forward. But it seems that the Fed remains very, very cautious in terms of there already being an improvement in inflation.
I'm going to put you on the spot here. Has it become more difficult to be an investor in this environment, and I suppose even for yourself as a portfolio manager?
I don't think any time is not difficult. When you think things are about to be easy, something comes from left field. But I think as an investor, as long as you maintain your process and your philosophy and carry that through, you are able to sort of ride the negatives. And I definitely think, I've said this before, and I'll reiterate that if you find those companies that have managed to sort of stabilize and firm up their balance sheets, so reduce debt significantly, but still able to generate cash flows And through the potential of a recession, if that's what we are still looking for going forward, that you find companies that are still able to generate sort of positive earnings growth or reduce negative, then I definitely think you have a winning formula.
Bringing it locally for a second, I mean, given the trading updates that we've seen on SENS, what are you expecting for our local earnings season?
So we've seen a lot of the miners have already come out with their numbers, and as expected, due to the commodity price rollover and concern around demand for commodities across the globe, we have seen a significant pullback in earnings level for these. And in that, we've seen the resource sector pull back significantly year to date. We've also seen the telcos come out with numbers, bit of a mixed bag with Telkom, I think not too surprisingly being the laggard compared to MTN and Vodacom. And so for the next few weeks, we're going to be looking out for the finance sector, so looking at the banks and the insurers to see what they come up with. And expectation is that not going to be as weak as the macros would you expect you to be, specifically in an increasing interest rate environment.
Speaking of that macro environment, I mean, going into, the second half of the year, what's the, I suppose, call it the Absa house view when it comes to your expectations for the macroeconomic environment?
It's hard to say, so it depends on who you speak to, but, we leave it to the professionals in terms of the macro and fixed income side and the economists. But the view at this point is that we are likely to continue to see interest rate increase environment with a view to look at what the Fed is going to do. I think where the sentiment is at the moment is more geared towards a environment where we get to peaking interest rates towards the end of the year, potentially rolling over into the first quarter next year, and then for a wait and see approach to be maintained before we see interest rates coming off.
Carmen, thank you so much for your time. Let's leave it there. That is Carmen Belwana from Absa Asset Management, giving us her perspective when it comes to the latest on the markets. We're going to take a quick break, and then when we come back, we'll have that conversation that I had with JSE CEO Leila Fourie coming up. So stay tuned.